Hello, everybody, and welcome to our 2026 second quarter, kind of our mid-year review here, quarterly webinar. Thank you all for joining us this afternoon. My name is Josh Sterling. I'm the Chief Investment Officer here at Klaas Financial, and I'm joined by Eric Schwartz. And unfortunately, we are missing Kyle Kite this quarter. He will be back next quarter, but it'll be just the two of us this quarter. I think we'll do a good job, right?
I think so. I didn't know we could take a quarter off. That's good to.
Well, today, like typical, our presentation today is going to last somewhere between 20 to 30 minutes on prepared content. And then at the end, we'll be answering Q&A for everybody. So at the bottom of your screen, you should see a little green button that says Q&A. If you have any questions throughout this presentation, go ahead and enter it in there. We'll take time at the end to answer the question. Now, today, we're going to go over a couple of topics. Like always, we'll go over what's happening in the economy right now. We'll have a couple of different slides talking about that. And then we're going to talk a bit about market performance, some of the special categories that we've been keeping an eye on this past quarter. And then we'll do a little bit of time talking about what this really means for you, what it means for your portfolio, and your financial planning. So let's go ahead and get started here. So like we've mentioned a few times already this year, we are celebrating our 50th year in business. It's a big year. We've had a lot of fun things planned throughout the year. You've probably seen an email or two from us, but we're going to continue to celebrate this big achievement throughout this year. So we'll probably bring it up every single quarter for the rest of the year.
Yeah, I think it's a good opportunity for us to thank all of our clients that are on the call right now for trusting us to help you plan for your future. And it's been a great run, and we're excited to see where things go in the future here.
Absolutely. And as a reminder how we got there, right now our company, 50 years in business, but we serve over 1,100 households, almost 1,200 households all over the nation. We have about 26 employees and now manage over 900 million in assets. So it's been, like Eric said, a good run. We've got a great business and wonderful, wonderful clients that we serve. All right, Eric, well, let's go ahead and kick it off. What's been happening in the economy?
Yeah, I'm doing the economic update here this quarter, and I wanted to kind of focus mainly on two main themes for the quarter. The first one is inflation. Josh, is it 2022 again? I'm scarred from talking about inflation for like literal years. But it's back in the news again. I don't think it's any secret that we have an ongoing war in Iran and the greater Middle East right now, and that has certainly contributed to some rise in oil prices, which are a big part of the consumer price index, which is how we measure inflation. And we saw a headline CPI rise recently here, and then kind of come back down. We'll talk about that here more in a moment. But you know, the supply chain disruptions we've seen in the Middle East as a result of the war have really driven or did cause inflation to spike briefly. And remember, investors get spooked by rising inflation because it creates concerns that the Federal Reserve may do, well, one of two things: either raise interest rates in order to slow down inflation, or just not drop rates as quickly as investors might have expected. And so whenever we see a spike in inflation, it's usually a cause for concern in the market to some extent. And we did see that here in the earlier part of the year in the first quarter. But we'll get more into that here in a moment. And I think the second theme that I wanted to focus on today is really the market recovery we saw in the second quarter here after quite a sell-off in Q1. So just kind of looking at what changed, right? What really fueled that growth in the second quarter. And I mean, it sounds old-fashioned, but corporate earnings, right? We had some really impressive outperformance on corporate earnings in the second quarter, and that bodes well for valuations in the market. Feels kind of quaint to say that because it feels like everything else drives the market these days. But good old fashioned strong corporate earnings really helped the market rally. And I think the other big piece of this that everyone's talking about is the impact of AI on the equity markets right now. And in the second quarter, we continued to see impressive capital expenditures in the space. And I know that sounds kind of wonky, but the reason that I wanted to pause on that is, I mean, I'm getting questions from clients all the time right now about, the impact of AI in the markets and how sustainable is it and all of these things. And obviously there are a lot of concerns about the valuations we're seeing in the AI space. But when we see things like really high capital expenditures in industries related to AI, it gives investors confidence, and it kind of to some extent buoys and at least for the moment justifies the valuations a bit more. So as we continue to see companies invest in that space, it really helped valuations in the space grow even more and kind of raise the market performance overall.
Well, those capital expenditures, I mean, it spurs growth. It helps the
Yeah.
economy grow further. It creates jobs. There's a lot that goes into that underneath the hood that helps drive what's really impacting the overall market performance. You also made an interesting comment on kind of interest rate expectations and where they may go in the future, which is a whole lot of, I'm not totally sure,
Right.
which is interesting because over the past few years, it really feels like we've known, okay, it's going to go in this direction, just how
Yes.
much. We're finally in a spot where we have arguments on both sides. So it's interesting to see that develop more over time and to put a different type of unknown back in the marketplace.
Yeah, it's again, it feels quaint a little bit, like, oh, the old rules still apply to some extent, and I think in the first quarter we had a lot of concern about which way interest rates might be going. Basically, no longer was it how many cuts this year. The question was, are they going to have to raise rates because
Mhm.
we saw this inflationary spike? But as concerns around that seem to have stabilized a little bit here through the second quarter, and I think as continued hopes um, for an end to the conflict in the Middle East, um, they've kind of allowed the market to move past some of those concerns for the moment, at least.
Yeah, absolutely. Well, should we dig a little bit more into oil?
I would love to. Let's do that. So I mentioned earlier, this discussion of the consumer price index and how we saw in the first part, or I'm sorry, in the first part of this year, we saw a spike in inflation that then sort of rebounded back down here. So we're looking at um, three measurements here. The blue line, that is what we would call headline CPI. So that is basically taking all of the goods and services within the consumer price index and valuing them to show the rise in general cost of living over time.
Mhm.
And then we have the orange line, which we call core CPI. Okay, so that's taking headline CPI and taking out the impact of energy and food in the measurement. And then lastly, what you're seeing with the gray in the background, that is showing the price of Brent crude oil. And so what we're seeing as we look at all three of these things together is we see this really drastic jump in headline CPI at the same time as we see a drastic jump in the price of Brent crude. So what that's telling us is we're seeing this increase in CPI, but it's largely due to these more volatile parts of CPI, which would be, in this case, fuel, but also food is known to be quite a volatile component of CPI. But then if you look at core CPI, again, we took out the impact of food and fuel here, or energy, and we still see an increase, but it's much more moderated, right? It's not quite as jump off the page and scare you as we see from headline CPI. And so the reason I show you this is I think this has been helpful for the market to kind of shake off some of the concerns of the inflationary spike we saw to start the year. And we're not suggesting that food and energy are not really important factors. They're a huge part of a household budget, and they definitely impact the purchasing power of consumers. But from an investment standpoint, core CPI helps us better understand if inflation is broad based or if it's really more limited to some of these more volatile components and perhaps not like a market wide concern. And, because we're seeing right now such a clear explanation of that, I think that's what helped the market kind of shake off that concern through the second quarter.
Yeah, and I think an important aspect on this, just to kind of frame up the thought process behind core versus headline. You might even wonder, well, why does core CPI even exist? Food and energy are really key, important things. I mean, those are things that are in your face every single day. You go fill up, you know when the price of gas is going up. You go to buy milk and eggs, you know when those prices are increasing. So it feels counterintuitive to just take those things away and say, nope, let's not look at that to see if inflation's here. But really, the reason why we look at core CPI is the fact that energy and food are incredibly volatile. We're only looking at a year and a half on this timeline here. If we were to stretch this out over a very long time frame, you'd see that that blue line is jumping left and right.
Yeah.
It's going up and down nonstop. When we look at it over really long time periods, we do get a smoothing effect, and it looks much more in line with core CPI. But sometimes it's so sensitive to supply chain disruptions, to any mispricing, that it gets a little noisy at times. And so when we're looking at this screen here, we're looking at some noise over the past 3-4 months. And so by stripping away energy and food, we can really see, okay, has this really baked in to the core CPI elements? It doesn't look like it's hitting right now. It could get baked in over time, but right now it seems like there's a direct correlation between oil prices increasing and top line CPI, while core CPI, removing that impact, looks to be more stable than everything else.
Yeah.
All right. Well, let's go ahead and take a look at the performance year to date. Last time during our quarterly presentation was what we see in that reddish box, end of Q1. We are looking at a portfolio here that started at the beginning of the year with $100,000, and it was invested in a 60% global equity and 40% fixed income portfolio. That's our most average portfolio that we see the vast majority of our clients utilize. And so when we looked at the end of Q1, it was in a bit of a tough spot. We came into that, and I think our overall theme was it's not as bad as it feels. And really, when we're looking at that time frame leading into April, we were leading into a time when the S&P was down 9% from its all-time market high to that moment in time. NASDAQ was down 12%. But a 60-40 portfolio wasn't down as bad. It was only down about 6.5%, which made it a little bit more stomachable, but still in the moment didn't necessarily feel great. But the conflict in Iran had just started. Oil prices just started to increase. The market wasn't really sure what was going to happen there. But over this last quarter, we not only saw it come back, but now we've begun hitting new all-time highs again. And at the end of this quarter, that $100,000 portfolio that had gone down to 96, 97,000 is all the way up at 107,000. And we see this as a pretty typical market. I know it doesn't feel good in the moment, but we do see typical kind of corrections where we see the market go down a little bit in the middle of the year, but maybe comes back at another point. But over a long enough time span, we do see markets normalize, generally return 6-7% in a 60-40 portfolio over a long enough time period. And we're seeing that play out here, where it was a tough spot at the beginning of April, but now, because we've kind of let things play out, see how the conflict kind of evolved over time, see how the market reacts. We're in actually a really good spot on the year. Now, that does come from a lot of different aspects on what's happening underneath inside the portfolio, but overall, in a pretty good spot right now.
And we'll get into a little bit more of that later. Josh is going to take us on a little journey today into the depths of the portfolios. So
Yeah.
stick around for that. But
Uh,
first, I think it's time to meet our new Fed chair.
Absolutely. So if you watch these presentations often, you might notice that we talk maybe a bit too much about the Federal Reserve. But it all ties back to the things that we monitor because inflation is in the news a lot. And one of the biggest combatants against inflation in the markets is the Federal Reserve. It's one of the biggest economic tools that we have here in the US. And it's an important institution. And last quarter, we knew that the Federal Reserve was going to go through a chairman change. We knew that Jerome Powell's term was up. He has been around for quite some time, but he's been the chairman for 8 years now, and his time was up. He was serving his last 4-year term, and we had nominated by President Trump, Kevin Warsh. And Kevin Warsh has a big background. He came from Stanford and Harvard. He served in investment banking for Morgan Stanley. He actually already served on the Federal Reserve Board of Governors. He was on from '06 to 2011. Since then, he's been in academia and the private sector. So he has a broad range of experience on this. And since his nomination, he has gotten approval from the Senate to sit as the chairman. And since then, he's already had one meeting on the board. And lo and behold, we did not see an interest rate decline. We saw interest rates being held at that Federal Reserve meeting. We did hear the normal conflict back and forth of you had one or two people want to lower rates, and then you had one or two people want to raise rates. But for the most part, most of the people on the Federal Open Market Committee wanted to keep rates stable for now until we have more information on how inflation is being handled in the future. So things seem.
Can I stop you for a second there, Josh? Sorry, I didn't mean to interrupt. I just wanted to point out something that you just said.
Yeah.
We focus a lot on the chair because they tend to direct the committee to some extent, but this is still a group decision, right? The chairman does not make the decision on his or her own. So I think that's just a really important point when we talk about changes at the top.
Yeah, definitely. This committee is made up of 19 individuals. You have 7 board of governors. Those are appointed by presidents, but they're appointed every 2 years. They serve a 14-year term. And then you have the 12 presidents of the regional federal offices across America. So you have a wide range of experience, a wide range of professionals coming in and making joint decisions on the direction the Federal Reserve should go. I think one of the interesting things that happened with Kevin Warsh coming in, and this may be a little bit too much detail here, but I think it's important to understand the things that we're paying attention to. We're not overly concerned with any of this because the board is a pretty well diversified, both politically, both experience, different industries that people come from. So we're not too worried about this. But Kevin Warsh came in and said, let's go ahead and evaluate some of the aspects of the Federal Reserve in terms of some of the data that we're looking at, the way we communicate to public, and some of the other elements behind the scenes. And this is a pretty normal process when somebody comes in and evaluating, okay, what should we look at? Are there opportunities for improvement? And that's kind of the point of having an independent force like this. A Federal Reserve that can evolve to the current economic conditions and all the vast, rapid changes that we're seeing play out right in front of us. And so looking at this, we think is an important process. And many different types of people outside of the Federal Reserve are coming in to help out. You're having individuals from academia, former global central bankers, people from like Brazil or Bank of England are coming in to help out on this, and some executives as well. And these key people are coming in evaluating how should we be looking at the Federal Reserve? What kind of data should we be looking at? Are we looking at it frequent enough? And they're going to bring this back to the board to then decide if they're going to implement anything. So not only do you have diversity on the people that are making these evaluations, but then you have diversity when you're looking at people who are actually going to be implementing these changes. So we look at this and we think, hey, the new federal head is coming in. He might be making a couple of waves on his entrance, but we're excited to see where things are going to go in the future. We're probably not going to hear a lot of changes for the first 6 to 12 months, but we'll be paying attention. We'll be watching it pretty closely. But for now, things seem to be pretty stable and going in a really good direction.
Yeah, I think that's a great explanation. And I think that when there's large changes like this, especially at the head of such an important economic body, it's just natural for there to be some concern, some worry, especially in a world like today where we're so polarized along political lines, as a country. But the Fed is and always has been an evolving um, uh, entity, and every new Fed chair that comes in puts their own mark on it. And so far, from what we've seen, like you said, Josh, not a lot of concerning behavior or discussion, regardless of how you look at it. So change can be a little bit uncomfortable, but it's a fact of life and of the Federal Reserve over the years. So, business as usual thus far.
Yeah, absolutely. All right, well, let's go ahead and jump into some of the really exciting aspects of the portfolio this year. Eric, do you want to kick us off on the number one performing asset class?
I would love to. We like to give all of you a little peek behind the curtain when we do these webinars. And one of the big stories of what we've seen out of the equity markets this year has been the performance of the emerging markets. In the second quarter, and frankly, 2025, we saw great performance as well. But in the second quarter, we just saw exceptional returns out of the emerging markets. They outpaced U.S. stocks. They outpaced the rest of the developed world. So think, like Europe and the UK and Japan, the developed economies. And we just saw, just incredible performance. And it was much of the performance was on the backs of countries like Taiwan and South Korea. We saw kind of an AI fueled semiconductor boom in those economies that was really, really impactful. And I think too, when oil prices started to decline about halfway through the quarter in May, that was a relief for some of the non-oil producing emerging markets countries. And even beyond the AI excitement and technology excitement from some of these countries, we saw growth in other sectors as well, in financials and consumer products and in industrial companies within these countries. So we saw incredible growth, and it was pretty well diversified within the economies, at least. And I think we tend to kind of jump into these things sometimes and tell you what's going on without fully defining, the asset class. So I wanted to just pause here and say, we talk about the emerging markets. Not everybody may understand what we mean when it comes to that. So this is one of the asset classes that we target within the portfolio construction. And the emerging markets are characterized by faster long-term gross domestic product growth. They are characterized by expanding consumer markets, and really they're the types of economies that have a lot of long-term growth potential because they're in that development phase. There's in many cases just a lot of expansion going on, so there's a lot of potential for growth by owning equities in those spaces. But they come with the other end of the sword, so to speak. They have higher risk than U.S. or even international developed stocks. They have potential for political unrest. They have issues with lack of infrastructure, for example, currency risk and commodity pricing risk. All of these things are more present in the emerging markets, but they're a really important part of the portfolio construction. I mean, to think if you weren't including the emerging markets in the portfolios, the amount of return, which Josh is going to talk about more here in a moment, that you would potentially have missed out on, is just astronomical. And I think the emerging market space has grown a lot in recent years. I think we used to think of it as like the BRICS countries, right?
Yeah.
Brazil, Russia, India, China, South Africa. But while not only is Russia not included in that space anymore, but you can see on the screen here the expansion of other countries that we now think of as the emerging markets.
Yeah, and I think it's also really interesting to think about emerging markets as not kind of a permanent place for these countries.
Yeah.
As countries grow and develop, they move from different points in where their economic development is, what their participation is on the global scale, going from nothing to frontier markets to emerging markets to developed markets. Actually, Greece has actually been voted in and is going to be included in developed markets starting in 2027. So you see that here under the emerging market category, that will no longer be on there because it's going to be included as a part of the developed markets next year. So I really think that the emerging market is an interesting place. It's definitely an important part of the overall portfolio. When you kind of step back and you look at the emerging markets, kind of its global position, 60% of global population actually is in emerging markets. 40% of global GDP is in emerging markets. In the MSCI ACWI, which is the All Country World Index for equity markets, only makes up 11%. So we have this big developing part of the world that is going to be a meaningful part of global growth in the future. And it just makes up a tiny part of the overall portfolio, but has a big impact. So yeah, while it comes with some more volatility, it's an important earnings driver in the overall portfolio.
And part of our job, specifically Josh's job, is to make sure that you can participate, you as an investor can participate in that growth and that opportunity, but that you're not overexposed and potentially taking on too much risk by participating.
Mm-hmm. All right. Well, I think we jumped around it too much. Let's look at the actual performance year to date. So the overall performance that we looked at this year, 9.9% in developed stock market performance. That includes the US and all developed international markets. That's a good return for year to date.
Yeah.
About 10%, that's pretty solid. But then we look at the emerging market stock performance, and about 250% more than the developed markets. So yes, we see some volatility on this, but in years when we can capture really high returns from emerging stock markets, it's an exceptional opportunity to do that. And Eric noted that South Korea, Taiwan were major drivers of this year. We actually see Seoul, Korea on here right now. They both returned, South Korea returned 108% year to date. Taiwan returned 71% year to date, up until the end of the second quarter. These two countries really are driven by technology. South Korea is made up of 56% technology in its equity markets, Taiwan 73%. These are big players and big companies that you all have heard of. Samsung, Taiwan Semiconductor. These are big players in the marketplace and have been important, vital drivers of performance in some of these markets. But it's been a phenomenal year. Let's go ahead and look at what things look like from year to year. And some of you might have seen this chart before. This is called a Callan chart. And it basically looks at performance of 5 different categories that we're looking at: emerging markets, international developed markets, US markets, and fixed income, just your typical bond portfolio. The final one that we have in green is our global 60/40 portfolio, which we chatted about a little bit earlier. But we're trying to strip out all the different categories within a 60/40 and showing what the performance differential between each one is every single year. So if you look on the left, you'll see 2006. Emerging market was the best performing asset class, returning 33%. Your bond portfolio, fixed income, earned 4% on the bottom. And then you go across the board and you can see how every single year it's not really the same. You're going to have different assets perform better during different time periods. It goes to show how it's very difficult to predict how these markets are going to perform over different time periods. Of course, over the last 10, 15 years, the US has been one of the best performing asset classes. But if we were to push this back to the early 2000s, into the 80s, into the 60s, you'd see this go all over the place with different assets returning much better or much worse over a long period of time. And so the whole point of this is to showcase how that 60/40 portfolio is never at the top nor never at the bottom. It tends to be your balanced portfolio solution where you get the benefits of the extra return, but you're not taking on the volatility, that swing of the emerging market, US, international equity exposure. You get the nice benefits along with it, but you're really going to hold that return performance right in the middle during that time. Eric, is this something that you bring up during meetings a lot?
Definitely. I mean, this is the backbone of our preaching of diversification to clients, right? I mean, if you look at year to year, I mean, we have a 20-year time frame here. You can see just the way that the different components of the portfolio bounce around, but by building a globally diversified portfolio through the 60/40, how you can just get so much more consistency, right? And that is really the name of the game, especially for our retirees, to have that dependable return without the significant ups and downs is really important. But just for example here, if we look at, we mentioned this year, emerging markets are up about 24% year to date. In 2025, they were up 34%, right? They doubled the returns of US markets. But if we look back to 2022, for example, you can see emerging markets were the worst performing asset. That's that volatility coming in from just the additional risks of investing in the emerging markets. So I think just really focusing on that consistency and understanding that, while US markets performed really well for quite a while, then we see something like 2025 where international and emerging market stocks nearly, in the case of the international developed markets, nearly double US performance. And in the case of the emerging markets, they do double US performance. And Josh, you mentioned this earlier. If you look at different time frames, owning international stocks is really important. I mean, you look at 2000 to, you look at the first 10 years of the
Lost decade.
Yeah, it's the last decade, 2000 to 2010. If you were invested in US stocks, you got 0% return, right? And that was, now largely a lot of that was the dot-com bubble and then the global financial crisis. But we just cannot preach enough the importance of being globally diversified. It's not always the most exciting thing, but it is so, so effective.
Mm-hmm. All right. Well, with that is everything that we have for prepared content. We got a couple of questions pop in. So as a reminder, if you have any questions, please go ahead and submit that into the Q&A below. But while we're here, we'll go ahead and go through some of these questions here. So the first question that we have is on SpaceX, and I'm not surprised. That made quite a splash. So really taking a look at what kind of happened with SpaceX, the inclusion of SpaceX in indices and how it basically came to market. We actually wrote a blog post on this. So if you haven't seen it, you can reach out to your advisor. Your advisor has access to the blog. We posted it on our socials as well, so you can find it there. Just talking about what actually happened with SpaceX and index inclusion. And so this isn't something that's come out of left field. An initial public offering, which is basically a way for private firms to come to public markets to raise money so that they can do investments within the business. Provide liquidity for existing stockholders. Lots of different reasons why they would come to public markets. This is a process that takes a long time, works through either one or many different investment banking firms. I believe there were over 20 investment banking firms on this IPO that happened. So this isn't something that just came out of nowhere. The headlines made it seem that way, but this has been something that's been in process for a long time. And when a stock comes to public markets, the big question comes out of, well, should it be included in the index? Should it be included in individuals' investment holdings? And so SpaceX, a relatively large company, larger than most that come to market, would be included in some of the bigger index providers that are out there. So your S&P 500, your Russell 1000. So some of the headlines talked about how it may be fast-tracked for inclusion in some indexes, but not in others. It may be a bit too much detail to jump into right now, but in short, it had been included in the Russell 1000, not in the S&P 500. But when we really look at this from a relative impact to individuals, we find that it really is very, very, very minor in your overall portfolio. Looking at SpaceX in the overall portfolio, if I'm remembering correctly, in the S&P 500 makes up 0.4% of the S&P 500, which of course it didn't get included in that one. But if we were to then roll that into an overall portfolio, it would make up less than 0.1% in a 60-40 portfolio. So while it made huge headlines on different rules that were being established for it, its rollout as one of the biggest IPOs ever, the overall impact on a personal level is relatively minor.
Yeah.
All right, Eric, we have another question here. Do I need to open a Trump account?
Good question. So as I guess as I answer this one, I will caveat it with, I mentioned earlier we live in quite a politically polarized world, and naming an account after a politician, I think, brings some inherent division to the discussion. But setting aside the name of the accounts and that sort of thing, we're getting a lot of questions about these because they are essentially an effort at a concept that's been in policy discussion for a long time. Something called baby bonds. This idea of like setting aside a certain amount of money when a person is born, that then can be invested and then potentially they can access it later on. But the Trump accounts are essentially a tax deferred investment vehicle wherein you can make a contribution on behalf of a child to this account, and you don't get to deduct the amount that you put into it, but any dollars that are in there, as they grow in the future, they grow on a tax deferred basis, meaning you don't pay any tax on it until you actually take the money out. They kind of behave a little bit like a what we would call a non-qualified annuity, where taxation is deferred until you actually draw money out, but you don't get a tax benefit on the front end. Now, the excitement around these, or the discussion around these, is around a potential government match of up to or a government contribution of up to $1,000. Now, this is for a specific group of children born. I'm gonna between 2025 and 2028. So it's specifically for that time frame. Children born during that time are eligible for this $1,000 contribution from the federal government. So to answer to more directly answer this question from the viewer, I think that especially if you have a child born between 2025 and 2028, it makes sense to establish an account like this, just because it's you get access to the $1,000 contribution. Outside of that, as a financial planner, I don't see a ton of benefit to the account, um, other than that it's an investment account that can be used to um, uh, grow your savings. There's not a lot of like tax benefit around it. Something like a 529 college savings plan, assuming that you're saving for educational expenses, that would provide more of a tax benefit over time. The tax deferred growth of this vehicle is not anything that I would say is like novel or out of the ordinary. But that $1,000 contribution, that is potentially that is novel and something that you may want to take advantage of.
Mhm. All right. Well, and as always, if you have any questions specifically around kind of your personal financial situation, if you personally should open that one, you can always reach out to your advisor and they'll be able to give you a hand with that. But all right, with that, that looks like all the questions that we have here. So thank you everybody for joining here today. We appreciate everybody. And thank you again for being clients and working with us for over the last 50 years. Thanks so much. We'll see you
Thanks,
next
everyone.
quarter.
Bye.
Bye.